This, a small group of men representing the most powerful banks in the world, board a private train car in the middle of the night. They travel under fake names to a remote island off the coast of Georgia. For 9 days, they meet in complete secrecy, drafting a plan that will fundamentally restructure the American economy. No press is present, no government officials know what's being discussed, and when they emerge, they've created the blueprint for an institution that will control the money supply of the world's rising superpower. This isn't a conspiracy theory. This actually happened in November 1910 on Jekyll Island. The men on that train weren't criminals. They were bankers and politicians, and the institution they created wasn't a criminal enterprise. It was the Federal Reserve, America's central bank. But here's what they never tell you. The Federal Reserve wasn't created to serve the American people. It was created to solve a problem banks had, and that problem was you. You, the depositor, who might panic and withdraw your money. You, the voter, who might demand that banks face consequences for reckless lending. You, the citizen, who might question why private banks get to create money out of nothing and charge interest on it. The question everyone asks is, do central banks control our economy? But that's the wrong question. The right question is, who controls the central banks? Because the answer reveals the greatest transfer of power in modern history, not from one government to another, but from democratic nations to unelected financial institutions that operate beyond public accountability. Today, we're going deep into how central banking went from a radical idea that Americans rejected for 130 years to the most powerful force in the global economy. And by the end, you'll understand why every financial crisis makes central banks more powerful, not less. To understand how central banks came to control nations, you need to understand what they actually do. Most people think central banks are government agencies that manage the economy. That's half right at best and dangerously wrong at worst. A central bank is an institution that has monopoly control over a nation's money supply. It can create money, set interest rates, lend to commercial banks, and determine how much credit flows through the economy. In theory, it uses these powers to maintain price stability and full employment. In practice, it uses these powers to protect the banking system from the consequences of its own mistakes. Here's the crucial part. Most central banks, including the Federal Reserve, are not government agencies. The Fed is a hybrid, part government institution, part private banking cartel. Its board of governors is appointed by the president and confirmed by the Senate, but the 12 regional Federal Reserve banks are owned by private commercial banks. The New York Federal Reserve, which conducts most of the Fed's operations, is essentially controlled by Wall Street banks. When the Fed creates money or sets interest rates, it's not asking Congress for permission. It's not subject to budget approval. It doesn't answer to voters. The chairman testifies to Congress occasionally, but the Fed's operations are protected from audit. Its decision-making is secretive, and its primary loyalty is to the banking system it emerged from. But it wasn't always this way. For most of American history, the idea of a central bank was considered dangerous and un-American. The United States tried central banking twice before the Federal Reserve, the first Bank of the United States from 1791 to 1811, and the second Bank of the United States from 1816 to 1836. Both times the charters were allowed to expire because Americans believed that concentrated control over money and credit was a form of tyranny. Thomas Jefferson warned, "I believe that banking institutions are more dangerous to our liberties than standing armies. The issuing power should be taken from the banks and restored to the people, to whom it properly belongs." Andrew Jackson campaigned on destroying the second bank, calling it a monster institution that gave unelected bankers power over the economy. When he successfully killed the bank in 1836, he believed he'd protected American democracy from financial tyranny. For the next 73 years, America operated without a central bank. And for 73 years, banks that made bad loans failed, depositors lost their money, and the economy went through boom and bust cycles. But here's the question. If Americans rejected central banking for generations, how did it come back? The answer involves a financial crisis, a manufactured panic, and a propaganda campaign that convinced Americans that they needed to give up control of their money supply to save themselves from bank failures. The irony is almost too perfect. The story of how America got a central bank begins with a problem that was actually a feature, not a bug: bank failures. In the late 1800s and early 1900s, if a bank made too many risky loans and couldn't pay depositors, it failed. Depositors lost their money. Other banks, seeing the failure, would become more cautious about lending. This was painful but self-correcting. Bad banks died, good banks survived. The system had built-in accountability. But from the bank's perspective, this was a nightmare. Every time there was an economic downturn, depositors would panic and rush to withdraw their money, a bank run. Even healthy banks couldn't survive a run because banks only keep a fraction of deposits in reserve. The rest is loaned out. So if all depositors demanded their money simultaneously, every bank would fail. Banks wanted protection from runs. They wanted the ability to create more money when they needed it to meet withdrawals. They wanted a lender of last resort that could provide unlimited liquidity during a crisis. In other words, they wanted to privatize profits during good times and socialize losses during bad times. But they couldn't just ask for this. The American public would never accept it. So they needed a crisis, and in 1907, they got one. The Panic of 1907 started when a copper speculation scheme collapsed, triggering a bank run. The Knickerbocker Trust Company, one of New York's largest, failed. Panic spread. Other banks faced runs, the stock market crashed, and the entire financial system appeared on the verge of collapse. But here's the twist. The crisis was contained not by the government, but by J.P. Morgan, America's most powerful banker. Morgan locked bankers in his library and forced them to pool their resources to support failing banks. He personally guaranteed funds to stabilize the market. The crisis ended because one man, a private banker, had more power and credibility than the U.S. government. The political class was humiliated. Progressive reformers were outraged that an unelected banker had more control over the economy than elected officials. Conservative businessmen were worried that there might not be another J.P. Morgan to save them next time, and the banks saw an opportunity. Leading bankers, particularly Paul Warburg of Kuhn, Loeb and Company, began a propaganda campaign. The message was simple. We need a central bank to prevent crises like 1907. We need an institution that can provide liquidity, stabilize the banking system, and prevent panics. We need the Federal Reserve. But there was a problem. Americans hated central banks and distrusted Wall Street, so the bankers couldn't be seen as writing the legislation. It had to appear as a government reform to control banks, not a bank scheme to control government. That's where Jekyll Island comes in. In November 1910, Senator Nelson Aldrich, whose daughter was married to John D. Rockefeller Jr., organized a secret meeting. He invited the most powerful bankers in America, Paul Warburg, Frank Vanderlip, president of National City Bank, now Citibank, Henry Davison, senior partner at J.P. Morgan, Charles Norton, president of First National Bank, and Benjamin Strong, representing J.P. Morgan. They traveled in secret to a private club on Jekyll Island. They used first names only to maintain secrecy, and for 9 days they drafted the legislation that would become the Federal Reserve Act. Think about what this means. The central bank that would control America's money supply was designed in secret by the exact banks that would benefit most from its creation. No public input, no democratic debate, no oversight, just bankers writing rules for bankers. When the plan was complete, they needed to get it through Congress without people realizing what it was. So they made it complex, bureaucratic, and boring. They called it a Federal Reserve to make it sound like a government agency. They established 12 regional banks to make it seem decentralized. They included government appointments to the Board of Governors to create the illusion of democratic control. But at its core, the Federal Reserve was designed to do one thing: protect banks from the consequences of their own failures by giving them access to unlimited money creation. The bill was introduced in 1913.
President Woodrow Wilson initially opposed it, then supported it after meeting with the bankers. The debate in Congress was fierce, but manipulated. Opponents called it a banker's bill. Supporters claimed it would democratize finance and prevent panics. On December 23, 1913, when many congressmen had left for Christmas, the bill passed. Wilson signed it. And American democracy permanently lost control of its money supply. When the Federal Reserve opened for business in 1914, most Americans barely noticed. It seemed like a boring bureaucratic reform. Banks could now borrow from the Fed when they needed liquidity. The government had more tools to manage the economy. What could go wrong? For the first decade, not much changed. The Fed was still figuring out its role. World War I dominated everything, and government war financing overshadowed Fed operations. But in the 1920s, the Fed discovered its real power. It could create booms and busts by manipulating the money supply and interest rates. During the 1920s, the Fed kept interest rates low and credit easy. Banks lent aggressively, the stock market soared, speculation became rampant. People borrowed to buy stocks, and stocks kept rising because more people were borrowing to buy them. It was a classic credit bubble, and the Fed was pumping air into it. In 1928-29, the Fed suddenly tightened. They raised interest rates and restricted credit. The bubble popped. The stock market crashed in October 1929, and instead of loosening credit to cushion the fall, the Fed kept it tight. Banks failed by the thousands. The money supply contracted, and the economy spiraled into the Great Depression. Here's what's crucial. The Fed could have prevented the depression. They had the tools. But Fed officials, particularly at the New York Fed, believed that some liquidation was necessary to clear out speculation. Let bad banks fail. Let the market correct. In other words, the Fed stood by and watched the economy collapse because their economic theory said it should. By 1933, unemployment hit 25%. GDP had fallen by 30%. Banks were failing at a rate of hundreds per week, and Americans were beginning to ask, what's the point of a central bank if it can't prevent economic catastrophe? The answer from the banking establishment was breathtaking. The Fed needed more power, not less. During the New Deal, the Federal Reserve's authority was expanded. The government gave the Fed more control over bank reserves, interest rates, and monetary policy. The logic was insane. The institution that had failed to prevent the Depression and arguably caused it through policy mistakes was rewarded with more power because only they had the expertise to manage the economy. This established a pattern that continues today. Every failure of central banking leads to more central banking. Every crisis caused by easy money is solved with easier money. Every bubble that pops is reflated with more credit. And with each cycle, the central bank becomes more powerful, more essential, and more protected from accountability. World War II cemented this power. The Fed financed the war by buying government bonds and keeping interest rates low. After the war, the Treasury and Fed agreed that the Fed would continue supporting government borrowing by capping interest rates. The central bank had become explicitly a tool for financing government spending. But the real transformation came in 1971. President Nixon ended the gold standard, the last constraint on money creation. Before 1971, dollars were theoretically convertible to gold, which limited how many dollars could be created. After 1971, there was no limit. The Fed could create infinite dollars without any backing except trust in the Fed itself. This was the moment when central banks achieved total power. They no longer needed to justify money creation with reference to gold reserves, trade balances, or any objective standard. They could create money purely based on their own judgment about what the economy needed. They became high priests interpreting divine will, except the god was their own economic models. And the models kept being wrong. The 1970s brought stagflation, high inflation, and low unemployment simultaneously, something Fed models said was impossible. The Fed's solution tightened dramatically under Paul Volcker, causing a severe recession that destroyed unions, crushed wages, and restructured the economy in favor of capital over labor. It worked to stop inflation, but at enormous human cost. The 1987 stock market crash brought the Greenspan era. Greenspan discovered that he could support the stock market by cutting rates and providing liquidity whenever markets panicked. It created the Greenspan put, the implicit promise that the Fed would prevent major market declines. It was moral hazard at a systemic level. Take risks, and the Fed will bail you out. The 1990s saw the dot-com bubble. The Fed kept rates low, credit flowed to absurd internet startups, and when it crashed in 2000, Greenspan cut rates aggressively to cushion the fall. This created the housing bubble. The 2000s brought the most reckless lending in history. Banks knew they could sell mortgages to Wall Street, which packaged them into securities the Fed would accept as collateral. Credit standards disappeared, housing prices soared, and everyone involved knew it was unsustainable but believed the Fed would prevent a collapse. In 2008, they were half right.
The 2008 financial crisis should have been the breaking point for central banking. Instead, it became the moment when central banks achieved total control. When Lehman Brothers collapsed in September 2008, the entire global financial system froze. Banks stopped lending to each other because they didn't know who was solvent. The commercial paper market, where corporations borrow for day-to-day operations, seized up. Stock markets crashed, credit markets imploded. The world economy appeared hours away from total collapse. And the Federal Reserve did something unprecedented. It became the lender, buyer, and guarantor of last resort not just for banks, but for the entire financial system. The Fed didn't just cut interest rates to zero. It created multiple emergency lending facilities with arcane names: the Term Auction Facility, the Primary Dealer Credit Facility, the Term Securities Lending Facility, the Commercial Paper Funding Facility. Each facility did essentially the same thing: created money to buy assets that nobody else would buy at prices higher than their market value from institutions that would otherwise fail. The Fed lent to investment banks, insurance companies, foreign central banks, and even non-financial corporations. It bought mortgage-backed securities, corporate bonds, and government debt. Its balance sheet exploded from $900 billion before the crisis to $2.2 trillion by 2009. It had created $1.3 trillion out of nothing. But here's what most people miss. The Fed didn't just prevent a collapse, it protected the exact institutions that caused the crisis from facing any consequences. Banks that had made reckless loans were bailed out. Executives who had destroyed their own companies remained wealthy from bonuses paid before the crash. Shareholders lost money, but bondholders were made whole by Fed support. And the homeowners whose mortgages started the crisis, they got almost nothing. Millions lost homes through foreclosure, while the banks that held their mortgages were rescued with public money. The implicit message was clear. If you're a large financial institution, you cannot fail. The Fed will not allow it. This is what too big to fail means in practice. Not that failure is impossible, but that the central bank will prevent failure regardless of cost. And the cost was staggering. Not in immediate taxpayer money, most of the Fed's loans were repaid with interest, but in moral hazard, wealth inequality, and power concentration. The Fed's policies created the largest wealth transfer from the poor and middle class to the wealthy in modern history. How? By keeping interest rates at zero and buying trillions in assets, the Fed pushed up the prices of stocks, bonds, and real estate. If you owned assets, you got richer. If you lived on wages or savings, you got poorer. The wealth gap exploded. From 2009 to 2020, the stock market tripled while real wages stagnated. The top 10% of Americans owned 89% of all stocks. The bottom 50% owned essentially nothing. Fed policy made the rich radically richer and called it saving the economy.
But the 2008 crisis was just the beginning. The Fed had discovered a new tool that would make it even more powerful: quantitative easing. QE is a deceptively simple concept. The Fed creates money and uses it to buy government bonds and other securities from banks. This puts money into the banking system, which supposedly encourages lending and investment. In reality, it inflates asset prices and subsidizes financial speculation. The Fed did 3 rounds of QE between 2009 and 2014, expanding its balance sheet to $4.5 trillion. Other central banks followed. The European Central Bank, Bank of Japan, and Bank of England all engaged in massive QE programs. Globally, central banks created over $15 trillion during this period. And what did this accomplish? Stock markets reached record highs, corporate debt reached record levels, real estate prices surged beyond pre-crisis peaks, but economic growth remained weak, wages stagnated, and inequality skyrocketed. The Fed had saved the financial system by making it more unstable, more unequal, and more dependent on continued central bank support. By 2019, the Fed tried to reduce its balance sheet and raise rates slightly. Markets immediately panicked. Repo markets, where banks borrow overnight, seized up in September 2019. The Fed had to intervene with hundreds of billions of dollars in overnight lending. The financial system had become addicted to Fed support and couldn't function without it. Then COVID-19 hit and central banks went into overdrive. What the Federal Reserve and other central banks did during COVID-19 represented the complete transformation from economic managers to economic controllers. In March 2020, as lockdowns began, financial markets crashed. The Fed's response was unprecedented in speed and scale. In 1 month, the Fed cut interest rates to zero, launched $700 billion in QE, restarted all the 2008 emergency lending facilities, created new facilities to buy corporate bonds, including junk bonds, backstopped money market funds, provided unlimited dollar swaps to foreign central banks, and committed to buying unlimited amounts of government and mortgage-backed securities. Then, the Fed did something truly revolutionary. It started buying corporate bond ETFs, not bonds from troubled companies that needed emergency loans, exchange-traded funds that included the debt of massive, profitable corporations like Apple and Microsoft. The Fed was no longer a lender of last resort, it was a buyer of first resort, propping up markets regardless of actual distress. By 2021, the Fed's balance sheet reached $9 trillion. It had created $5 trillion in 18 months, more than during the entire 2008 crisis. And it wasn't just the Fed. The ECB, Bank of Japan, and Bank of England engaged in similar programs. Globally, central banks created over $25 trillion between March 2020 and December 2021. The result was predictable: inflation. Not immediate because lockdowns suppressed spending, but by 2021, as economies reopened, too much money chased too few goods. Inflation, which central banks had insisted was dead, roared back. In 2022, U.S. inflation hit 9%, the highest in 40 years. Central banks insisted they were shocked. They called it transitory. They blamed supply chains, Putin's invasion of Ukraine, corporate greed, everything except their own money printing. When they finally raised rates in 2022-2023, they did so reluctantly and slowly, terrified of crashing markets that had become dependent on cheap money. But here's what's crucial. Even while causing inflation through money creation, central banks became more powerful, not less. Why? Because they're now seen as the only institutions capable of managing the problems they created. The government can't fix inflation through fiscal policy because that's politically impossible. Raising taxes or cutting spending is electoral suicide, so central banks are the only game in town. They create the boom with easy money, create the inflation with excessive money creation, then position themselves as the only solution by raising rates and causing recessions. They create the problem, worsen the problem, and then claim credit for eventually solving the problem they caused. And throughout this cycle, they're expanding the scope of their power. Central banks now talk about climate change, inequality, social justice, and other issues far beyond monetary policy. The ECB considers environmental sustainability in its bond purchases. The Fed discusses racial equity in employment. The Bank of England talks about social responsibility in lending. These might be important issues, but they're not monetary policy. They're social policy. And unelected central bankers are making social policy without democratic input or accountability. But the most disturbing development are central bank digital currencies, CBDCs. Central banks worldwide are developing digital currencies that would allow them to directly control citizen spending, not just influence the money supply, but literally control what you can buy, where you can spend, and how much you can save.
China already has a digital yuan with programmable limits. You can be restricted from certain purchases, have expiration dates on your money to force spending, or be frozen out of the financial system entirely with no due process. Other central banks are watching China's system with envy, not horror. The Fed is researching a digital dollar. The ECB is developing a digital euro, and they frame it as innovation and convenience. But what it represents is the final stage of central bank power, direct control over individual economic behavior without needing banks as intermediaries. Here's what should terrify you. The pattern that created central bank power is accelerating globally, and every crisis makes the system more entrenched. Look at the European Central Bank. Created in 1998 to manage the euro, the ECB was explicitly forbidden from financing government debt. That lasted 12 years. During the 2010 European debt crisis, the ECB started buying government bonds. During COVID, they bought trillions more. Now, the ECB routinely finances European government spending, and nobody pretends the restriction still exists. The ECB has gone further than the Fed in some ways. When Italy's populist government proposed fiscal policies the ECB opposed, ECB officials openly threatened to stop buying Italian bonds, which would have crashed Italy's economy. An unelected banking institution threatened an elected government with economic destruction for pursuing policies it didn't like. That's not monetary policy, that's political control. The Bank of Japan pioneered the most extreme central bank policies. Faced with deflation and stagnant growth in the 1990s, the BOJ cut rates to zero, then went negative. They bought government bonds, corporate bonds, and stock market ETFs. The BOJ now owns over 50% of Japanese government bonds and 7% of the Japanese stock market. A central bank owns 7% of the stock market. Think about what that means. The central bank is directly controlling equity prices, not just influencing them through interest rates. And it hasn't worked. Japan has had near zero growth for 30 years despite unprecedented monetary stimulus. But the BOJ can't stop. If they stopped buying, interest rates would spike, the government couldn't afford its debt payments, and the financial system would collapse. The BOJ is trapped in perpetual intervention, and so is Japan. This is the future every central bank is creating: perpetual intervention, permanent asset price support, and complete dependence on continued money creation. Now look at the pattern across crises. 1907 panic created the political will for a central bank. Solution: Federal Reserve. Great Depression: Fed policy failure. Solution: more Fed power. 1970s stagflation: Fed policy failure. Solution: give Fed independence from political pressure. 1987 crash: market panic. Solution: Greenspan put. Fed will prevent major declines. Dot-com bust: bubble created by the Fed. Solution: even easier money. 2008 financial crisis: credit bubble created by the Fed. Solution: $4 trillion in QE and emergency lending. 2020 repo crisis: markets can't function without Fed support. Solution: resume QE disguised as technical operations. 2020 COVID: lockdowns crater economy. Solution: $5 trillion in money creation. 2022-23 inflation, caused by excessive money creation. Solution: rate hikes that cause recession but maintain expanded Fed balance sheet and powers. Notice the pattern. Every crisis leads to more central bank power. Every intervention creates conditions for the next crisis. Every crisis is worse than the last. And every time the solution is more of what caused the problem. This isn't incompetence, it's the system working as designed. Central banks were created to protect banks from market discipline. Every expansion of their power serves that purpose. And because they're protected from democratic accountability, they never face consequences for failure. But here's the shocking data that reveals the scope of control. The combined balance sheets of the Fed, ECB, BOJ, and Bank of England reached $31 trillion in 2022, roughly 30% of those economies' combined GDP. These institutions have created money equivalent to 30% of all economic output without producing anything of value. Global debt reached $300 trillion in 2023, 356% of global GDP. This debt is only sustainable because central banks keep interest rates artificially low and buy government bonds. Without central bank intervention, most developed nations would face sovereign debt crises. Asset prices have completely divorced from economic fundamentals. The stock market keeps hitting records while real economic growth stagnates. Real estate is unaffordable for entire generations, and both are sustained purely by central bank policy, not actual productivity or prosperity. And here's the most disturbing statistic. 90% of global central banks are researching or developing CBDCs. The system is moving towards direct central bank control of money, not just the money supply, but individual money. This is the endgame of central banking, total monetary sovereignty with no intermediaries and no escape. The parallels to historical power consolidations are obvious. Rome debased its currency to maintain military spending. The result was inflation, economic collapse, and eventually the fall of the empire. Weimar Germany printed money to finance government. The result was hyperinflation and fascism. Every empire that gives control of money to a powerful institution without accountability eventually faces monetary collapse. We're in that process now. It's just slower and more sophisticated than previous examples. Central banks create money, governments spend it, banks lend it, and asset owners benefit. The losers are wage earners, savers, and anyone not holding real assets. The system redistributes wealth upward while claiming to serve the public good. So what are the lessons from the rise of central bank power? First, institutions created to solve crises always expand their power during crises, and crises always seem to require more power for those institutions. The Federal Reserve was created to prevent financial panics. It has presided over dozens of panics, each one worse than the last. After each failure, the Fed gains more power because it's positioned as the only institution that can manage the crisis it helped create. This isn't a bug, it's the design. Institutions don't limit themselves. They expand to fill available space, and central banks have learned to create the space they need through crises that demand their intervention. When you see the Fed or other central banks responding to economic problems with emergency powers, understand that these powers never become temporary. They become permanent, and they establish precedent for even more power next time.
Second, unaccountable power always serves the powerful, regardless of stated intentions.
Welcome to the
Central
future
banks
of
claim to
UGC
serve
video
the public
creation
interest,
with Jog AI.
stable prices,
Just type your
full
script to
employment,
get started.
financial stability.
Welcome to the future
But
of
look at who
UGC video
benefits from
creation with
central
Jog
bank
AI.
policies.
Just type your script to
Not
get
wage
started.
earners who see their purchasing power eroded by inflation, not savers who get zero interest on deposits, not young people priced out of housing markets. The beneficiaries are banks that get bailouts, wealthy asset owners who see their portfolios soar, and governments that can borrow without limit. Central bank independence means independence from democratic accountability, not independence from pressure by financial institutions. When institutions don't answer to voters, they answer to power. And in monetary systems, power means banks, wealthy asset holders, and governments that benefit from unlimited money creation. Third, the distance between central bank intervention and authoritarian control is shorter than anyone wants to admit. Right now, central banks influence the economy through interest rates, asset purchases, and lending programs, but they're moving toward direct control through CBDCs. The difference seems technical, but it's revolutionary.
Programmable money means central banks or governments working through central banks can control individual economic behavior. They can prevent certain purchases, enforce negative interest rates by making money expire, or freeze accounts without due process. China's digital yuan already does this. Western central banks insist they won't, but they also insisted they wouldn't finance government debt or buy corporate bonds or keep interest rates at zero for a decade. Every line they draw eventually gets crossed when they decide it's necessary, and once CBDCs exist, the temptation to use them for control will be irresistible. Now here's the warning we need to confront. The system can't continue without increasingly extreme interventions. Central banks have created a financial system that's dependent on permanent support. Asset prices are sustained by central bank buying. Government borrowing is sustained by central bank purchasing bonds. Bank liquidity is sustained by central bank lending. Remove the support and the system collapses. But continuing the support requires ever larger money creation, which eventually causes inflation, currency debasement, and loss of faith in money itself. Central banks are trapped between two catastrophes: stop intervening and trigger a financial collapse, or keep intervening and trigger monetary collapse. They're choosing the second option because it's slower and less obvious, but it's still collapse. Real wages in developed nations have stagnated for decades while cost of living soars. Younger generations face economic prospects worse than their parents for the first time in modern history. Wealth inequality has reached levels not seen since the Gilded Age, and all of this is downstream from monetary policy that benefits asset owners at everyone else's expense. The central banking system isn't managing the economy toward prosperity. It's managing a controlled decline, where the powerful extract maximum value before the system breaks completely. And when it breaks, and it will break, central banks will demand even more power to fix it. CBDCs will be sold as the solution to the next crisis. Direct central bank lending to citizens, programmable money to stimulate spending, negative interest rates to punish saving. Each step will be justified as necessary, temporary, and for the public good. And each step will move us closer to a system where unelected financial institutions have direct control over individual economic life. The day the bankers won wasn't a single day. It was November 1010 when they met on Jekyll Island, December 1313 when the Federal Reserve Act passed, August 1971 when Nixon ended the gold standard, September 2008 when the Fed bailed out Wall Street, March 2020 when central banks created trillions to respond to COVID, and tomorrow when CBDCs give central banks direct control over your money. It's every day that democratic nations accept that unelected financial institutions should control the money supply, influence political decisions, and determine winners and losers in the economy without public accountability. The Federal Reserve was sold as a reform to protect the public from banker panics. In reality, it protects bankers from the public's demand for accountability. It was designed by banks for banks to eliminate the market discipline that banks faced before central banking existed. And the model has spread globally. Every major economy now has a central bank with similar powers and similar lack of accountability. Every central bank responds to crises by expanding the money supply and protecting financial institutions. And every central bank is moving toward digital currencies that will give them unprecedented control. The question isn't whether central banks control nations. They do. The question is whether democratic societies will ever take that control back. And the answer appears to be no, because taking back control would require accepting short-term pain, bank failures, recession, market crashes that modern voters won't tolerate. So we keep accepting more intervention, more money creation, and more power for institutions that operate beyond democratic control. The bankers won. Not through conspiracy, though the Jekyll Island meeting was certainly conspiratorial. They won through the simple mechanism of making democratic nations dependent on institutions that serve banking interests. And that dependence is now so complete that questioning central banking power seems radical, uninformed, or dangerous. But maybe it's more dangerous to accept that small groups of unelected officials should control the money supply, determine asset prices, finance government spending, and soon control individual economic behavior, all while operating in secrecy and without accountability. If this video changed how you think about central banking and monetary power, subscribe because we're exploring how financial institutions actually operate beyond the myths they tell. And if you want to understand how to protect yourself in a world where central banks control money, check out the video on assets that survive monetary collapse. The principles haven't changed in centuries.